Okay, strong day. Actually, relatively strong day, right? I mean, 100 points plus higher. 22,061 is where we're at. Manish Dangi is with us from Mosaic Asset Management. Manish, good morning. Good to have you with us here. Thanks for your time. So, what are you picking up, Manish? What's the market really trying to price here? Because last few days, at least equities have been a little weaker. We've sold off about 4% from the highs.
I mean, we are actually 6-7% relatively right versus US. And so this is all Modi anxiety, I would say. It's all in the grip of sort of super local macro and political macro, so to say. I think market needs a confirmation of its original prior that it had. And it's sort of, there are cracks in it right now, I presume, and which is what is driving right now. So if markets are possessed, I would say, it's nothing to do with economy or earnings.
I know, absolutely. But there's no way to, I mean, first of all, no one knows. The second, there's no way to sort of, given that there is no way to, sort of put on a trade with that, even if you have a view, right? Except, of course, I mean, if you're too long and too overloaded and too much on the speculative side, you kind of reduce that. Do you reckon that is what has been happening?
See, there are two parts to it. One is what's your view on elections? And second, and rather more importantly for folks who run risk, is what's your framework? I think on a political macro, the framework should be Modi, weak Modi, or no Modi. And I kind of bring it down to in an election in a country like ours, because he is so hegemonic, and discontinuity there would mean extremely divergent policies. And there's sort of an important macro here that, first time in last 40 years since 90s, the opposition camps economic policies are so divergent from the incumbents that there is a huge wedge now. In case there were to be something, even though of low probability were to happen, you will have to reset all market and which most importantly bonds, currency, but also to a certain extent equities. So I think a return of strong Modi, of course, is business as usual. Return of weak Modi essentially is a listless market and sort of a 3-4 years of a relatively sort of weaker macro, so to say, at margin. As state elections unfold and his hegemony and the policies hegemony of the incumbent actually weaken. And no Modi, of course, is all hell break loose. Especially bonds have to reprice, significantly higher inflation, currency has to weaken by 3%. And all these sort of heft that, in terms of P and other valuations sort of market has put on since 2014 has to pretty much unwind. Because that, not because, of anything else, but the economic policies of the opposition is going to be very, very different. So that's the framework you should use. What's your view? I mean, everyone has a view in this country as to who's in what form the next government will be.
What's the global framework? You believe the global structural setup is conducive for global risk and commodities. Tell us about your thesis.
Structurally, see, commodities essentially is a China proxy, and it's even though China is weak relative to pre-COVID regime, but it is certainly gaining traction. The consumption part, of course, is still weak at 3% or thereabouts retail sales growth. But in general, if you track IIP, electricity demand there, PMIs, sort of everything seems to show that things are picking up. Something similar could be said for even Europe. Even from a monetary policy standpoint, US stands alone. We've seen, Sweden actually cutting rates. So this time the West is not together. And the high rates are actually hurting the rest of the world a lot more. And therefore, there is this case to make that, you will have softening of rates in rest of the world, even when, Fed actually dither. Now, that sort of regime is what I see over the next 3-4 months. And then eventually, even Fed begins to cut for all the reasons that we've discussed many times. So that's the setup, which could because commodities are proxy to China and other places instead of just US, I guess I guess it's likely that commodities do decently well.
And what about the India structural? Of course, in India everything looks good. The macros are strong, resilient. But what are the cyclical trends that you've picked up?
India cyclically, of course, outside of politics, India has, let's say, two parts, capex or investment. I think household balance sheets are leveling up and there's a decent traction there. So after a very long sort of re-leverage of household balance sheet, actually it's accelerating. It's not thawing yet. Industrial capex actually is still soft, but it's certainly better than what we've seen in last few years. So it's sort of a return of 2019 like setup. So that's on the capex side cyclically. On the other side, which is consumption, household consumption, which actually forms a large part of GDP, that sort of still remains very, very weak. Especially when you look at data through staples and stuff like that, we sort of realize that a large part of household balance sheets in India are stressed likely and are not levering, are not actually consuming. So there is sort of a split there. There is a decent chance of a capex recovery over next 3-4 years, but absent that, India would actually struggle. But my bet is that there'll be a reasonable capex recovery, at least cyclically.
Okay, cyclical recovery. Broadly speaking, and we had Nathan Sheets of Citi in the morning with us, Maneesh, and I was asking him whether, generally speaking, it's a very conducive environment for risk assets through the course of the year in major markets, right? And his answer was yes, because the rate easing cycle, etc. The promise is there. The when is the question, and promise is something markets can live with as long as it is there somewhere on the horizon. So it keeps one excited, keeps one looking forward to the future. And it's not as if, a big hiking cycle has hurt markets in any big way, but I guess we'd like easing. So just your thoughts, would you agree with that kind of a view, Maneesh?
So, yes, in a sense, market is in this setup where it desperately needs bad news. And the bad news is good news adage, which worked until about a few years ago. It's only post 2021 the bond equity correlation broke. So we are in that setup. Equity is looking for bad news, but not very bad news. So in a sense, mild slowdown, and inflation sort of continues to sort of taper off. That's the regime that equity wants and is pricing in. Of course, there are other alternatives, other possibilities and sort of decent chance of it. It could be a hard landing, which is a recession setup in which, rates go down dramatically, but equities don't rejoice because, the first order impact is on the EPS. The earnings actually drop. The Q4 earnings in, let's say, S&P is baked at 15-17% higher in terms of analyst expectations. There is a decent chance that there'll be a huge disappointment there if there were to be recession in next 3-6 months. So that could be an alternate setup, and you can't say that there is no possibility of that. And then, of course, there could be a very, very a very, very bad scenario in terms, the growth slows, but inflation stays tight. In some sense, in last 2-3 months, we've seen this, right? Last 3 months, inflation has been stubborn in US particularly. And in last 1.5 months, you've seen a PMI relapse, NFP data has been weak. Yesterday's, the job loss data, sort of all suggest that, the slowdown, albeit slow, is still sort of progressing. So that is a setup that equity won't like. So in this framework, I think the first that let's have bad news, let there be a softening of sort of economy and lower yields, but not such a bad news that it impacts the EPS is what, equity is hugging to. It has a 1/3 chance, let's say, but other two possibilities are quite malignant.
Maneesh, thank you very much for joining in. Good conversation.